The next major market crash isn't some far-off fantasy. It's a real, looming possibility, something every serious investor should be thinking about right now. You may not see it coming in tomorrow's headlines, but the warning signs are already here. The only question is, will you be prepared, or will you watch your net worth evaporate overnight? If you're watching this, you're already ahead of 90% of people, because most won't do a thing until it's too late. They'll keep spending, keep speculating, keep assuming the bull market will last forever. But markets don't go up forever. They never have. They never will. Let's rewind. In 2008, global markets fell apart in a matter of months. Trillions of dollars were lost. Homes, retirements, lives changed forever. All because too many people were over-leveraged, underinformed, and in denial. Even seasoned investors weren't spared. Now fast forward to 2020. A pandemic no one predicted sparked one of the fastest crashes in stock market history. Within just 4 weeks, the S&P 500 plummeted over 30%. And yet, those who had cash reserves, strong portfolios, and a clear strategy not only survived, many thrived. So let's fast forward to today, 2025. We're living in one of the most unpredictable financial environments in modern history. Global debt is at all-time highs. Geopolitical tensions are rising. Inflation is erratic. Interest rates remain stubborn. And AI is reshaping industries faster than regulators can react. All of this creates instability. And instability, that's the breeding ground for crashes. So how do you protect yourself? It starts with understanding why most people lose everything when markets collapse. It's not just bad luck. It's poor planning. People get greedy when prices rise. They FOMO into hype. They overexpose themselves to risky assets without understanding the fundamentals. Then the market turns, and they panic sell at a loss. They react emotionally instead of strategically. They confuse short-term volatility with permanent loss. And here's the kicker. Most people think they're diversified, but they're not. If you own 10 different tech stocks, you're not diversified. You're just putting all your eggs in one high-risk basket. True diversification means spreading risk across different asset classes, sectors, and income streams. We'll come back to that. But first, let's break down the 5 key strategies the wealthy use to protect their wealth before a crash, and that you can start applying today. 1. Build an emergency fund and keep it untouched. This is your financial shield. A bare minimum of 3 to 6 months of living expenses should sit in a high-yield savings account. Not in stocks, not in crypto, not in NFTs. Cash. Liquidity equals flexibility. It gives you breathing room when everyone else is suffocating. When layoffs hit, when the market freezes, when credit gets tight, you'll still move freely. That's power. 2. Rebalance your portfolio regularly, not emotionally. Think of your portfolio like a garden. It needs pruning, maintenance. Rebalancing forces you to sell what's grown too fast and reinvest in what's undervalued. This protects you from bubbles and ensures you're not accidentally overexposed. Example, if your stock allocation has ballooned from 60% to 85%, that's a red flag. Rebalancing brings it back to sanity. Bonus tip. Use rebalancing events to review your long-term goals. Has your risk tolerance changed? Has your timeline shifted? Your portfolio should reflect your reality, not just the headlines. 3. Avoid leverage like it's TNT. Leverage can magnify your gains, but it multiplies your losses even faster. Let's say you're 2x leveraged and your position drops 30%. You're down 60%. Now imagine margin calls, forced liquidation, and sleepless nights. That's what millions experienced in past crashes. If your investment strategy requires borrowing money to work, it's not a strategy, it's a gamble. Stick with sustainable returns, not seductive ones. 4. Own real assets, the kind you can touch. In uncertain times, real value matters. Paper wealth, like stocks and bonds, can collapse in sentiment-driven downturns. But hard assets hold. Gold, farmland, real estate. These aren't just old school, they're timeless. Even Bitcoin, while volatile, has become part of the digital scarcity conversation. We're not saying to bet your life on it, But diversifying into hard or limited assets can act as a hedge, especially when fiat currency faces pressure. Remember, don't just chase returns, chase resilience. 5. Prioritize cash flow over just capital gains. Here's a secret. The wealthiest people don't rely on price appreciation to survive. They rely on cash flow, dividend-paying stocks, rental properties, digital assets that yield real returns, even small online businesses or automated income systems. Cash flow gives you options when the market is crashing. It keeps you afloat. It removes the pressure to sell at a loss. Ask yourself, if my portfolio dropped 30% tomorrow, what part of it would still pay me monthly? If the answer is 0, it's time to rethink. Now, let's shift gears to the most overlooked risk in any crash: your own psychology. We are emotional creatures, and fear is a powerful force. When markets fall, news outlets scream, social media panics. Everyone becomes a financial expert overnight. But here's the truth. The worst investment decisions are made under emotional pressure. Your job is to remove emotion from the equation. Prepare when things are calm, so you can act when others freeze. Most people ask, when will the crash happen? Wrong question. The right question is, what will I do when it happens? If you don't have that answer now, you won't have it when the storm hits. So what do the wealthy do differently? They expect downturns. They don't panic when assets lose 20%. They see it as a sale, not a tragedy. They have dry powder ready. They move silently, strategically, without emotion. They invest in systems, businesses, products that work in any economy. They don't gamble on hope. They engineer resilience. And that's exactly what you can start doing right now. Because here's the bottom line. Wealth isn't built during the boom. It's protected and often multiplied during the bust. So don't wait for permission from the market. Act now. Audit your finances. Strengthen your foundation. Diversify with intention. And prepare like the next crash starts tomorrow. Because when it does, most will panic. But you'll be ready. Hit that subscribe button for more real strategies to protect and grow your wealth. And if you know someone who's still sleepwalking through this economy, send them this video. It might be the wake-up call they need.